Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, today Mena and I would like to talk about establishing a corporate beneficiary. And we're going to talk about, what does that mean? Sometimes it's called a bucket company. It's a very common and very useful tax saving mechanism. But unfortunately, it's all too common that we see that these corporate beneficiaries are set up incorrectly or not in time to actually utilise them. And so what we wanted to do today is talk about, some of those common mistakes and also, make sure that you as a listener has a good understanding of how they work and how to utilise them.
Maybe before we do that, Stuart, we'll talk about the purpose and benefits real quickly, and then I'll talk about the sort of key structure and considerations around setting these up. So basically, a corporate beneficiary just allows you to shift profit from your trust into a more tax-effective environment. So hypothetically, if you've made $1 million and you've only got two beneficiaries, you don't really want to be necessarily splitting those profits 50-50 between you guys, because you'll be paying close to 47 cents on a dollar for any income above 190,000. Sometimes we will do that strategy. This isn't a strategy, it's not a one size fits all, by the way. But in most cases, we'll establish a corporate beneficiary as a sort of a tax deferral mechanism. So we'll basically get money out of the main trading entity. We park it in a corporate beneficiary where we'll only pay 25 or 30% tax, so the tax rate's quite capped. As well, it gives us a level of asset protection. So it's not only for used for trust. Sometimes we'll use it for if you've got a main trading company, we'll flash out dividends and get the retained profits out and park it in the corporate beneficiary just to limit the balance sheet's net asset position. When we set these up, unfortunately, as Stuart mentioned, we've seen a lot of these that have been set up incorrectly. Now, when we say incorrectly, you really want to set up a corporate beneficiary that still provides you with the flexibility to distribute profits at a later stage. Now, the most common mistake that we often see with these corporate beneficiaries is the shareholdings listed as individuals rather than another family trust. Now, when it's listed as individuals, that means you've got a whole bunch of profits sitting in the company that when you need to get the money out, you're forced to pay a dividend to the same shareholders, the same one or two individuals that are in the main trading entity. So in effect, you've actually achieved nothing. But when you've actually replaced it with a trust gives you the ability to further distribute those funds to any beneficiaries at a later stage who may be at lower tax rates or any other family members who might be at lower tax rates.
One of the possible outcomes of using a corporate beneficiary is falling foul of the Div 7A compliance regime. And so that occurs when a trust makes a distribution to a corporate beneficiary but doesn't actually pay the cash across into that corporate beneficiary. And if it doesn't, it means that it's a deemed loan to the corporate beneficiary, and so the trust needs to pay interest to the company, and of course the company then has taxable income and then needs to pay tax on that. So whilst we might look at it as, an individual might look at it as it's just a paper transaction, it's no big deal, but actually it is a big deal because you'll be paying tax on interest that is paid, even though that interest might be kind of a paper transaction. So how do you navigate this? Well, firstly, you can obviously pay the cash across. And we prefer that. That's our preferred mechanism. If we're going to distribute into a corporate beneficiary, we really want to have a strategy on how we're going to get the cash into that corporate beneficiary. If we're making a distribution just solely to minimise tax, but actually our client has gone and spent that money, like on living expenses or something like that, all we're doing is creating a compounding tax problem and overcomplicating matters. And people in business need to realise that, hey, if we're going to spend the money, if we're going to go on holidays and live a lavish lifestyle or do whatever we want to do, we're going to spend that money, then we've got to pay the tax on that money. You can, as I said, you can try and delay it, but you'll just create a compounding problem and you'll end up paying more tax in the long run because it'll take time to sort of unwind those arrangements. So we like to then understand with our client, how much money are you spending on living expenses? So how much money do we need to take out of your business into your personal names? But if we do have surplus, so they're not spending all their profit, then that's when we will start to use a corporate beneficiary. And that's why moving the money into the company and investing in that company, whether it's in property or shares, whatever it might be, tends to be the best way to go. Sometimes there can be a bit of a timing difference. So elect to make the distribution, but we haven't yet got the profits, and we're going to move those profits in over the next 12 months or 18 months. You have about a year of grace before it becomes a Div 7A problem. If you then don't actually move the monies across, then you will have to create a Div 7A loan agreement, and you'll need to comply with that agreement. So it charges a benchmark interest rate, which is what, about 10%?
No, over 8% at the moment.
8%, yeah. Right, okay. So it's not cheap, which means that you'll be paying tax 30% on that 8%, so the tax bill can kind of mount up, if you like, and the loan needs to be repaid over 7 years. And if you keep distributing to a corporate beneficiary and not paying the cash, it means you'll have several Div 7A loans, one for the 25-year distribution, one for 26 distribution, and so on and so forth. And it's something that the ATO is really focused on in terms of making sure there's enough compliance. And as I said, the loan is over 7 years, so what you'll actually have to do is declare a dividend out of that corporate beneficiary to make the loan repayments. So by not moving the cash, you're going to pay tax on interest, and then you're going to pay personal tax on, or some sort of tax wherever that dividend goes, probably personal tax on the dividend income. So as I say, you can delay tax sometimes, but sometimes the delay comes at the cost of paying more tax in the long run.
So when setting these up, there really needs to be a long-term strategy in place. I think what happens is, and we always talk about accountants who focus on short-term goals, I want to save tax now, but how do we deal with that in the future? So how do we deal with the profits that are actually distributed into that corporate beneficiary? So what we do in our practice is that we consider, okay, can we invest those profits that are distributed rather than sitting there or going to the beneficiary? Can we instead invest it and make those funds grow, and then as an exit strategy, once in retirement or the children turn 18 or something like that, we can flush those dividends out and benefit from the franking credits associated with those distributions. It's a particularly great strategy when planning for retirement as well. We've got a lot of clients that are nearing retirement, for example, and we'll encourage them, okay, let's actually do this as a distribution strategy now. Might not be the most tax effective for the short term because we're not topping them up to the right sort of tax brackets. But we know in the future income years, when their income is reduced, when they're retired, we can actually flush those dividends out and get all the franking credits or the tax credits back. And it's also a great sort of intergenerational planning tool as well. So, all my beneficiaries need, how can I fund their education, for example? I might be able to flush those dividends out. They'll be studying, so they'll be at a lower tax rate. I can fund their education expenses. So there's got to be a strategy in place before anyone considers incorporating a corporate beneficiary or a bucket company.
I like to think about it as a third super fund, Mena. So, normally spouses will have their super fund each, and then the corporate beneficiary can be a third super fund, in that when you enter into retirement, you can draw pensions from your super, but those pensions are non-taxable. So you'll have no personal taxable income. And therefore, we can take advantage of that by then drawing dividends out of the corporate beneficiary. And as Mena said, you get a credit for the tax already paid. So those dividends will be franked. So whilst you pay the 30% upfront in terms of tax, you might be able to get it back over the next sort of 10 or 20 years. And to put some numbers around it, because obviously I've got to pay the tax today, and then I'll get some back next year and the year after and the year after, and so on and so forth. If you look at the time value of money, what you end up paying is around 10% tax. Now, it's going to be different for different people in different amounts, but it's not zero because obviously we've got to pay it up front and then we get it back over many years. But it's, 10% is nothing to sneeze at, of course. We've got to think about sort of long-term strategy in terms of exit strategy. So how does the corporate beneficiary work within your longer-term retirement plan? Also, one of the benefits of having a corporate beneficiary as opposed to a trust is that a trust vests after 80 years, which is not going to be a problem certainly for Mena and I, but will be a problem for our children potentially, whereas a corporate beneficiary is an evergreen entity. It can continue on. So if your goal is to create some intergenerational wealth, a corporate beneficiary can be a really great way, a really effective way of doing that, because it doesn't need to pay a dividend if it doesn't want to. It can just pay the 30% tax and keep the profit in that company. And, you can hand over control of those entities, through your succession plan. So what you do is name some replacement directors if you passed away, and those directors then take over that company. So it could be your children and so forth. So it can be a great way to not only save tax today on your business profits, but then also create a environment to invest those monies over the next period of time, to then potentially enjoy those monies in retirement, and even to pass on those monies to future generations.
So finally, I'll probably just talk about the main risks associated with establishing corporate beneficiary. And obviously we've talked about the structuring considerations, but these are more sort of legislative risks and pitfalls. Now, the ATO does harp on about this in our blogs and podcasts previously, but they're really on a warpath lately. So they're really focused on these unpaid present entitlements, or the Division 7A loans that Stuart mentioned earlier, and the misuse of these corporate beneficiaries. So basically, think about when you declare a distribution to a corporate beneficiary, but you've actually used the funds personally. So the funds haven't gone to the company and you've taken it personally, you've spent it without declaring a dividend and without putting it in a complying Division 7A loan. All these can lead to declarations of unfranked dividends, with franked or unfranked dividends, and it can lead to a large tax bill. So make sure, if you're using a corporate beneficiary, that you've got the right sort of strategy in place, the right loan agreements in place if you do have a Division 7A loan, and that you're actually complying, because again, the ATO are heavily monitoring this sort of legislative guidelines around corporate beneficiaries.
So hopefully that gives you a bit more of a flavour for using a corporate beneficiary or bucket company. Just make sure it's set up correctly, make sure you've got a strategy, and I guess that's the key theme of many episodes in this podcast. Don't just do something for the sake of tax. Make sure that it's a more well-rounded decision to make sure ultimately it's going to improve your lifestyle at some point in time and improve your personal financial position. So that's really thinking broader about, okay, how are we going to use this structure and how can we use this structure to build wealth rather than just focusing on tax this year. All right, that's enough for us for today. Until next week, bye for now.